So you guys have heard me mention long-term compounding and long-term returns of an investment several times. But what does the long-term return of an investment really depend on? How do we estimate that? There are three components of a stock's long-term returns. Number one, the growth in intrinsic value of the core business. Number two, the capital returns in form of dividends or share buybacks. And number three, the re-rating of the market multiple. So we will go over each of these three in detail. Now, the returns from the growth in intrinsic value of a business, that comes from the earnings growth that the business enjoys over a long period of time. The returns from the capital allocation decisions, that comes from the dividends or the share buybacks which the business makes. Now, stock investors should understand that in the long term, it is hard for a stock to earn a much better return than what the underlying business earns. So if the underlying business earns a 5 to 7% return on capital, then over the long term, say 20 to 30 years time, the stockholders' returns cannot be too much different. Even if the stockholder has paid a hugely discounted price when buying the stock. On the other hand, if a business is earning a 20-25% return on capital, then over a 20 to 30 year period, the stockholders' returns will also be fantastic, even if they paid an expensive looking price initially. This is provided that the business is able to keep deploying additional amounts of capital also at such high rate over the years. Now, let's take the example of two companies. One is called Compounder Inc. and the other is Undervalued Inc. Now, at the time of entry, both these businesses have an earnings power of about $1 million. As an investor, I buy Compounder Inc. at a P multiple of 20x, whereas the Undervalued Inc., as the name suggests, is available at a very cheap P multiple of 10x. So the total valuation of Compounder Inc. is $20 million and the total valuation of Undervalued Inc. is $10 million at the time when I purchased the stock. Now, let's assume that Compounder Inc. has a very high return on capital and is able to reinvest 100% of their earnings every year at the same high return on capital of 25%. Whereas in case of Undervalued Inc., they're only able to reinvest 50% of their earnings and the returns generated on the retained earnings is just 8%. So in a 10-year period, the cumulative dividends that Compounder Inc. pays out is zero because everything is reinvested in the business, whereas Undervalued Inc. pays out about $6 million worth of dividends. Now the year 10 earnings power of Compounder Inc. shoots up to $9.3 million. This is simply the $1 million compounded at a rate of 25% for a 10-year period. Whereas the year 10 earnings power of Undervalued Inc. is only $1.4 million. Now let's assume that I decide to exit these two businesses, and at the time of exit, both the businesses are available at a P multiple of 15x. So there has been a de-rating for Compounder Inc. Remember, when I bought it, it was available at 20x, but now it's available at only 15x. Whereas in case of Undervalued Inc., there has been a multiple expansion from 10x to 15x. Year 10 valuation using these multiples is significantly different between the two companies. For Compounder Inc., it's almost $140 million, whereas for Undervalued Inc., it's just about $21 million. So the IRR returns that I have received for these two businesses is significantly different. 21.5% in case of Compounder Inc., whereas only 12.2% in case of Undervalued Inc. Now here, as the Undervalued Inc. company has been paying out dividends, so to do an apples to apples comparison, we need to compare the internal rate of returns. And this is the pre-tax internal rate of returns. So this shows that the long-term return of a business, it doesn't matter how cheap or how expensive one buys the business for, the long-term return tracks closer to their return on capital. Now, in case of undervalued Inc., if the re-rating from 10x to 15x happens quickly, then the returns can be quite satisfactory, as majority of the returns will be due to the re-rating. However, the stockholder would be better off exiting the position and looking for a replacement idea immediately. And longer it takes to find the replacement idea, the worse the compounded returns will get. And you can understand this mathematically. If the P multiple has doubled during the holding period of a stock, now if this doubling happens in a 3-year period, that results in a 26% compounded return. But if the holding period is 30 years, if it takes 30 years for this doubling of P multiple to happen, then that re-rating just adds 2.3% to the overall compounded returns. While in case of compounder Inc., the compounding, which is the growth in earnings power and intrinsic value, might not have had the time to show its major effect in a short period of time, but with the passage of time, the gap between the high quality compounder Inc. and the low quality undervalued Inc. will become wider and wider in favor of the high quality business. So clearly, time is a friend for the high quality business, but an enemy for the low quality business. Now, my personal preference, as you can very well tell by now, is to invest in businesses where my investment returns would correspond to the improving operating performance of the business as compared to a market re-rating. Now, for me, I would obviously look for a high quality business at a cheap price so that the market re-rating or the P multiple expansion is a welcome bonus. But that would not be the sole objective for me. Unlike many deep value investors who are buying a business at a deep discount only to see the re-rating happen and the gap between the intrinsic value and the market value close up. The advantage of opting for the high quality business is that it eliminates the need to be right about market timing and also does not need me to come up with too many replacement ideas. So for me, it's kind of a lazy way of investing where my focus goes in a detailed analysis of the business, and after that, I'm very happy to leave it to the management and the CEO of the business to do their magic over time. So this difference between a compounder and a flipper, it's somewhat like a compounder is somewhat like a farmer who invests in a farm to enjoy the proceeds from the farm over a long period of time and would benefit from the increase in value of the farm mainly due to the increase in the productivity of the farm, as opposed to the flipper, who is our deep value investor who invests in the farm because it was available very cheap only to be able to sell it to someone for a profit once the market discounts correct. Now, I would like the best of both worlds. I would like to buy a productive farm at a deep discount and let time do its magic. The best business to own is one that can invest large amounts of incremental capital at a very high rate of return over a long period of time. Whereas the worst business to own is one that needs large amounts of capital to grow the business but generates a very low rate of return on that incremental capital. The growth of a company's intrinsic value depends on the returns it can earn on its incremental invested capital, that is ROIC. And we will see in detail how this ROIC is calculated. Some businesses might have great returns on the initial capital invested, but may not have the ability to reinvest internally in growing their operations. So they need other avenues to reward their owners. Let's take the example of a town center pub in a small town, which is very popular with the patrons, and generates $100,000 of net earnings. Let's assume that this net earnings is similar to its cash earnings. And let's say the owners initially invested $500,000 of capital. So this business is generating a return of 20% on the capital invested initially, which is actually a very healthy return. Now, while the business is doing very well, unfortunately, there is not much opportunity to grow the business. So what do the management do with the $100,000 of cash profits that they generate every year? Now, the neighboring towns all have their own favorite pubs, and this current town does not have the capacity to support any more additional pubs. Now, the owner, of course, might decide to get into a different business and invest the $100,000 of earnings in that business, but in all likelihood, that new business will not generate the same 20% ROIC. It is difficult for a new business to establish the reputation that this pub has established among its patrons with its friendly staff, cozy ambience, great food, etc. Now, even though a business with a legacy moat may enjoy high returns on invested capital, that is the ROIC, if you purchase their stock today and own it for, say, 10 or 15 years, it's unlikely that as an investor you will achieve exceptional returns in terms of growth in the stock price. This is because the high ROIC reflects the returns on the initial capital that was invested. But there are very little avenues for investing the incremental capital for businesses like this pub. In other words, a 20% reported ROIC today is not worth as much to an investor if there are no more 20% ROIC opportunities available to reinvest the profits. So business like this town center pub will probably resort to distributing the profits as dividends or use it to buy back the shares of its core business. Or maybe it could look at acquisition opportunities if there are suitable opportunities available. All these alternatives fall under the capital allocation decisions. So businesses which do not have much internal compounding growth opportunities through reinvestment of earnings for achieving value accretive growth, they can also create significant shareholder value by means of disciplined capital allocation. And that happens through dividends or share buybacks when the share price is depressed below the intrinsic value of the business, or even smart acquisitions when the share price is elevated. So then the business can use the elevated share price as a currency for the acquisition. Now, in the long run, the change in market value tends to be approximately same as the change in intrinsic value of the business, plus any value added from these capital allocation decisions. And as we have already discussed, the re-rating of the market, that is the P multiple expansion, does play a role, but the effect of that re-rating of the market multiples, they diminish with the passage of time. If you want to learn about some great examples of creating shareholder value through capital allocations, I would highly encourage you to read the book by William Thorndike. This book talks about some of the greatest capital allocators of the corporate world. So now let's look at long-term compounders. These are high-quality businesses that can grow their intrinsic value at very high rates over a long period of time. And that is regardless of what the economy does or what the stock market does or what earnings multiples do. We look for businesses that not only produce high returns on invested capital, but can also reinvest a large portion of its earnings at similar high returns. This is where a business achieves the true compounding power. ROIC usually only tells us the rate of return the company is generating on the capital that they had initially invested, sometimes many years ago. But obviously, a company that produces high return on capital on an ongoing basis for the new capital that it's investing, that is the kind of business that interests us. Now, to understand the importance of this reinvestment of incremental capital that we have been talking about, let's take the example of two businesses, company A and B. Now, both have high ROIC, but company B has a 22% ROIC, whereas company A has 18% ROIC. So B is actually a lot higher. But company A has the advantage of being able to reinvest 100% of its earnings, whereas B can only reinvest 30% of its earnings, and the rest is distributed as dividends. Let's assume that the company A is available at a much more expensive P multiple than company B when we bought into the business. So again, both the companies have earnings power of $1 million at the time of our entry, and company A is available at a P multiple of 20, B is available at 10. A is being able to reinvest 100% of its earnings, whereas B is able to reinvest only 30%, and A reinvests 100% earnings at 18% ROIC, whereas B is reinvesting only 30% earnings at 22% ROIC. We show the cumulative dividends that B pays out. So whatever B is not being able to reinvest, it pays out as dividend. And in year 15, let's assume that the P multiple for B remains the same at 10, whereas A undergoes a derating. So remember, when we bought A, we bought it at a P multiple of 20, but let's assume that in year 15, the P multiple of A is only 11. Now, even after the derating and even after the fact that A's ROIC is 4 percentage points below B's ROIC, we see that both companies have similar internal rate of returns after a 15-year period. And that is because of A's ability to invest its entire earnings, which unfortunately B can't. So in case of A, what is happening is the earnings grow at a compounded rate of 18% multiplied by 100%. Whereas in case of B, the earnings would grow only at a compounded rate of 22% multiplied by 30%, which is just about 6.6%. And that makes the huge difference. So now if we assume that after 15 years, both the companies are available at the same P multiples that we paid at the time of buying the stock, we can see that A's results are significantly better than B's. And this is apples to apples comparison because we are taking the IRR, which also takes into consideration the ongoing dividend income that B has generated. So this shows that in the long run, it is the ability to invest the incremental capital at a high rate that sets a business apart in terms of shareholder returns. So the compounding power of a business is equal to the ROIC, which is return on incremental invested capital multiplied by the reinvestment rate. So in case of A, this compounding power is 18%, whereas in case of B, this compounding power is only 6.6%, which is 30% multiplied by 22%. So the long-term value of a business is derived from its ability to retain its high ROIC. This happens if the business has a strong moat which fends off competition. And when a business is generating a high return, it constantly attracts competition to come and get into the same business. So I would like to encourage you to do some thinking through here. Now, as a business with high ROIC gets bigger and the profits become more meaningful, its high returns usually attracts more and more competition and their gross margins are attacked. So thinking logically, we seek businesses that instead of falling under such competitive pressures would actually become stronger as they get bigger. And we like businesses where the moat actually becomes stronger as the business becomes bigger. So what kind of businesses would meet this criteria? Now, there are two business models that lend itself to this kind of a moat, which gets stronger with size over time. One is, of course, businesses with a low cost production or scale advantage. So because of their growth, because of their higher volumes, they command better prices. So their cost of production or cost of offering some services go down. However, what we like even more are businesses with a two-sided network effect. For example, a business like Airbnb or the Amazon marketplace. Now, these are classic examples of businesses where bigger they grow, stronger their network moat grows. For example, in case of Airbnb, the more the number of travelers on the platform, the more attractive is the platform for house owners. And the more the number of house owners on the platform, the more attractive is the platform for travelers. So that moat gets stronger and stronger as the business grows. And the chances of this business getting attacked by competition is much less compared to other traditional businesses. So to summarize, we like businesses that have the ability to reinvest incremental capital in the core operations at a high rate of return, and whatever it is not being able to invest in the core operations, we would like superior capital allocation skills so that the CEO can allocate that capital in ways that's value accretive for the shareholders. And of course, we like to buy these businesses at a discount so that the market re-rating or the P multiple expansion can also add a few percentage points to our long-term returns. In the next video, we are going to run you through an example of how to estimate the ROIC of a business. Thank you very much for your time.